Good morning, good evening, everybody. Thank you very much indeed for joining us today. Today, with my guest, Haim Aziz, we want to talk to you about the prospects for the residential property market post-Brexit at last. Only took, 3 and a bit years to get through. And as we approach the end of the pandemic, hopefully it looks as if there's a very strong light at the end of the tunnel here in the UK. It's worth, I think, reflecting on where the market has been during the sort of times of uncertainty, the peak uncertainty, and what we see the prospects going forward to be realistically. We've got Haim with us today. He runs a company called the Estates Office, and the Estates Office has been a very important partner of ours for the last, 5-10 years now, as suppliers to us and helping to source and originate deals that we in turn will then pass on to our investors. So there are a few people in a better position to actually say on the ground what's really happening in the market, what has been happening, and what he thinks is going to happen going forward. He's based in London, so we hear a lot of the noise in the press and the media, but realistically, we never really speak or hear from anyone on the ground that actually is talking about real life experiences as to what's going on in the market and potentially what we think is going to happen in the next sort of 12, 24 months, which is why we're here today. Next slide, please. So before I introduce you to Haim, I wanted to give you a little bit of context on us and our business. I think many of you know who we are. But just to clarify, so we are an investment business. We're not selling the dream. We're not selling places to retire or go on holiday to. For us, it's all about buying investment property to make money out of, both in yield and capital growth. We tend to focus on areas of regeneration, where infrastructure is being improved, capital cities, commercial hubs, in global locations, but really those are the locations that we tend to favor based on the fact that they give the best liquidity, so you can sell when you want to sell further down the line, and when you're holding on to the asset, you've got the best chance of getting the yield that you want and the occupancy that you want. Next slide, please, Casey. So in terms of where we are as a business, we've got a number of offices globally, as you can see. And next slide, please. You know, for us, I guess there's a sort of three-pronged approach. I mean, one of the reasons I hear so often as to why people don't invest in property, they think it's too hard. It's quite overwhelming in terms of the information that's around these days. So, you know, you just don't know where to start. So we've very much started our business on the basis of research. We're going out, we're understanding the market fundamentals in all of the areas that we look at and presenting this curated information to our investors that's in an easy to read and understand format, so that you can make informed decisions. We're offering an end-to-end service. So basically what that means is that we go out, we look for the real estate investment opportunities. We hold your hand throughout the whole purchase process. So for example, you know, you don't need to go out and find your own lawyers. We would recommend lawyers that have represented our investors in the past and tax accountants, etc. So throughout the whole transaction, we will assist. Once the transaction is completed, we will then assist you with mortgage finance. If you want mortgage finance, we'll talk more about interest rates later. And also lettings and management. I mean, that's a big piece of what we do. It's the world's worst job if you're trying to do that yourself from overseas in terms of time zones and maybe languages in certain countries. So we absolutely have that infrastructure to manage all of that yourselves. So our goal really is to present real estate investment like any other investment that you have. Make it as passive as possible, make it as transparent as possible, so that really it fits in with your whole portfolio. So just a quick word on that middle box. So we underwrite, and that's where Haim is so important to us, because he presents us with opportunities that we underwrite. What does that mean? It basically means that once we find a deal that we're happy with, that we understand is in the right location at the right price, there's little enough supply in the area that we think there's going to be sufficient demand from the rentals for the next sort of 3, 5, 10 years, we will go in and actually put money down, and the deal is that any units that are not taken up by our investors, we buy. So they go on our balance sheet. So that's so important. We're all aligned with our investors, and ultimately we're not expecting our investors to put money in where we're not already invested ourselves. So that is one of the key differentiators. And I think if you're looking at any other sort of property investment partner, I mean, there's plenty of people around, you need to find out exactly how they make their money and how they're aligned, I think, before you sort of engage further. That would be my advice to you. So without further ado, let me hand over to Haim, who I think will give some context on his business and then talk about the market as he sees it at the moment. So over to you, Haim.
Thank you very much, Jonathan. So a very brief introduction as to State Office. We're a business that's been established since 1983, and we only deal with the trade, meaning we sell sites to developers, investment property across all sectors. So it can be residential blocks of flats, office buildings, distribution, and as I say, we work with all sectors. Since inception, what makes us very different is we work with inward investors from overseas. They could be family offices or larger pension funds that are looking to get into the UK real estate market. The next slide, please. We're a boutique business. There's 20 in total. We're very diverse, and some of the data and access to the market is without competition. It's just through contacts where we can deal one-on-one with the owners and try and piece deals together for our clients. Can I have the next slide, please? I've put this slide together to give you an idea of prime yields across all sectors in real estate between October 2019 and October 2020. The reason you'll see is this is after COVID, the effects that it's had to yields for investors in the commercial space. And I mean, you'll see, just taking a very, very brief glance at the table, in certain sectors, which is retail and parts of hospitality, that there has been a yield change, but in most sectors, that the yield has basically carried very, very well, and that there's still, even with COVID, huge demand from investors seeking yield and wanting to invest in the UK. That's both from investors already located in the UK and inward investors from overseas. Can I have the next slide, please? So this slide talks about residential versus other sectors within the marketplace, and how we've seen pricing and yield since the beginning of COVID. That there was an announcement early this morning. The Chancellor is looking to extend the stamp duty holiday till June. It's definitely helped. It's definitely a driver, and I believe it's a very, very positive driver for the market. It does help affordability, and it helps first-time buyers, assist them getting onto the property ladder. whereas maybe before that they were waiting, that they are using this as a a real reason to buy and get onto the property ladder now. So anyone that says that COVID has had downward pressure on pricing, it's just simply not true. It's not what we've seen on the ground. And as a small business, I can tell you last year was one of the best years, 2020, that we've had in a long, long time, which doesn't really make sense when you read the press, the newspapers, but on the ground here in London, that there is a lot of demand. Maybe the volume of transactions are lower to what we're used to. There's less availability, but there's still plenty of demand from investors seeking to invest in real estate. Can I have the next slide, please? Sorry. Looking ahead to this year and beyond, I would say that there's very strong fundamentals, especially for the residential sector, and pressure from the government to develop more housing. One of the reasons that London is a very, very strong property market, which we've had for many, many years, is supply and demand. We're not meeting the quotas for housing, and there's all sorts of reasons around that, we just simply don't have enough housing for the demand, and that's one of the main reasons that the property market is where it is and is very robust. I do see pressure on rents, especially in central London. One of the major factors in that is the lockdowns that we've been having and the restrictions over travel and overseas. So a lot of the landlords, the professional landlords that we speak to that own larger blocks in central London are telling us that they are seeing pressure on rents anywhere between 10 and 15% from their what they would be used to collecting in rent pre-COVID. But we see that as being a blip in the market, and that's something that will come back as soon as travel and overseas students or overseas workforce are back in the UK. Capital is very, very cheap, and we are reading and hearing in the press about negative interest rates, and that's pushing investment even further from private clients into both commercial and residential property. Hospitality is an interesting space if we talk about hotels or bars and restaurants, but they've gone through a very, very tough time in the past year. But I think it's logic to say that once the lockdowns are over, that this is a sector that will bounce back very, very quickly indeed. As for locations within the capital, within London, I would say that the best locations for capital growth is still regeneration locations within commuter distance into both central London or the city. I know that there was a lot of talk around HS2, but that's happening, and Crossrail's absolutely happening as well. So I would stick to locations where have very good connectivity and a nice local areas where people would like to live and bring up a family. I think that's very important. The next slide, please. I think that's the end of the presentation. If you have any questions, I'll be very happy to help where I can.
I'm glad you said that, Chaim, because we have got quite a few questions that sure. Came through. I think one of the benefits of IP Global working with a company like the Estates Office is that we have a sort of a retail and institutional view of the world and the market. And I think, Chaim, we were just chatting beforehand, weren't we? Maybe you could mention what you were talking about yesterday to the fund manager that you were talking to, and what his observations of the world are.
Yeah, so I was with a fund manager from a listed UK property company yesterday, showing them a property for sale and asking what their thoughts and outlook was for the next few years. And his view was very simple, that if you compare London as a capital city versus other capital cities in the globe, whether it be New York, Paris, Hong Kong, Barcelona, London does look cheap in terms of yield compared to other cities on a global scale. And there's a lot of equity, a lot of money in the system chasing yield. And we can see that in some of the transactions that have happened in the marketplace the past 6 or 12 months. There's a very interesting sale that happened to a very large Hong Kong conglomerate that bought an asset on Oxford Street last year. So in the middle of the first wave or first lockdown, the highest peak that we had here in the UK, and the pricing that the asset sold for was not very different at all to the height of the market 2 years prior to that. So that shows very, very strong demand, and we haven't seen a big correction in pricing, only in certain sectors, as I said before, retail and parts of hospitality.
Yeah, I think a lot of people, I mean, if I think back to the dark old days of 2008, 2009, during that financial crisis, there were, I mean, asset prices fell off a cliff, didn't they? Virtually overnight, 20, 30% down, and there were virtually no transactions, simply because I think, well, I think the primary reason for that there was no liquidity in the bank. So if you wanted to buy something, you had to use cash, or that was it. And I think there were some people hopes, some people hoping, others expressed concerns that the same was going to happen again. But this time there is so much liquidity in the system that if you look at the numbers, certainly back in December, there were more people taking out mortgages than there have been in the last sort of 5-6 years. So no shortage of activity there, and no shortage of liquidity in the system. So yeah, I think, dare I say it, this time it is different to the last. I'm just reading out a couple of questions here, Haim. We've got a question here. With the effects of COVID, some people are unable to pay rent. What insurance do landlords have against to protect themselves from tenants who don't pay rent in the UK?
There isn't an insurance that I'm aware of. If anything, right now, that there's a moratorium over evicting tenants. And in the commercial world that I'm in, if a landlord is selling a building at the moment, it's very, very difficult to provide vacant possession, and he would have to sell the building with the tenants in situ. My answer to this question is that if you're going to be renting your property, you have to be very commercial today and do all the usual checks over the tenant, and be absolutely sure that the tenant that's coming in is stable, he or she have got a stable job, and just to take a commercial view as to the type of tenant that's moving into your flat, and they're going to be able to sustain the rent.
Yeah, I think that's absolutely, I mean, that's one of the keys to using a decent property management company that should absolutely reference the tenants and do the due diligence on them, so that they can see that absolutely they have the wherewithal to pay their rent. Yes, you can't sort of foretell the future to an extent, but also you've got a reasonable idea that if they've got a good track record of paying, they're probably going to keep going if they possibly can. Another question we have is, in what way will the London property market differentiate from, say, the Manchester or Liverpool market? So going forward in the next 5 years or so, what do you think is going to happen to those markets, Chaim, if you can sort of compare all three, London, Manchester, Liverpool?
Of course. So history's shown us that the capital is always the first to bounce back from any type of blip or pricing adjustment, or if we say the word recession. What's happened in the regional cities, if we take Manchester, Liverpool, Birmingham, this is very new. That this has all happened in the past, I would say 7 to 10 years, where we've had a spike in capital growth and rental yields. A big driver for this is the connectivity and the new infrastructure the government are putting in. So we were in Birmingham yesterday to show a building. We were there in an hour and 20 minutes, which is fantastic. Sat on the train and were there in no time.
It'll be quicker when the HS2 finishes, won't it? It'll be less than an hour.
Much quicker, much quicker. And it's affordability.
So HS2 is 100% been signed off now, hasn't it?
Yeah, that's correct. Look, it's affordability. I've got a good friend who's got 2 young children, and he decided to move to Birmingham. He gets a lot more space for his money when he buys a house, and it's affordability. And what we're seeing in the regions with the capital growth, I believe that there has to be a ceiling, that it can't just keep going. Where London, prime London, I remember in 2000, we reached £1,000 a foot, and people were saying it will never go over £1,000 a foot. It's impossible. And yet, you know, we've seen pricing hit 3,000, 3,500. So I don't think there's a ceiling. Whereas if you take some of the regional cities, there has to be a ceiling, because Manchester can't outprice London. It just doesn't make sense. That there's no rationale there.
Yeah.
So I hope that helps.
Yeah, I think that the gap will close, but the London prices will never equal Liverpool or Manchester. I mean, they're 3 very, very different cities. They all behave in their own ways. But I think the key to it, as you say, I mean, London has always been this sort of capital preservation play. People have always been prepared to forego a bit of yield on the basis that they feel safe and secure with an asset there. And maybe some of these northern cities, the cash flow is definitely better. But as you say, in a downturn, the secondary, tertiary cities are the ones typically that will go first and the most quickly. But again, if you've got a 5-10 year view, which you should do with property, it doesn't matter. The key thing is that rather than try and be too smart about, you know, foretelling prices and where they're going to move, is just use your common sense and buy in areas that are undergoing that regeneration. Be smart in who your tenants are going to be, and just concentrate on that cash flow over the sort of medium longer term, and the rest should absolutely take care of itself.
Yeah, I agree with you.
We've got a question. What sort of commercial property would you recommend at the moment if you were going to be buying commercial property, Chaim? I know we're supposed to be talking about residential, but that inevitably creeps in. So what would your recommendations be for the types of commercial property that are the most popular at the moment?
It's very interesting. Last year, we saw an influx of private investors buying into supermarkets and small convenience stores on high streets, whether it be Co-op, Tesco's, Sainsbury's. And as a private investor, I would say that would be right now the safest sector. The typical yield that you'd find in that sector, if we're talking about London within the M25, for a long lease of 10 or 15 years of guaranteed income, anywhere between 4 and 5% net yield is what we're seeing in that space. That's my answer. I believe that would be the safest sector at the moment.
So not traditionally, the office space was perceived as being that sort of safe bet. I mean, obviously there's discussions going on now about potential large corporates downsizing, not having the need for people to go into the office every day. And what are you seeing on that side at the moment, Chaim?
Offices were changing prior to COVID. So traditionally in the UK, we were always used to, as investors, as long leases, meaning you could buy a building let to HSBC Bank, for example, which is rented on a 15, 20 or 25-year lease. Prior to COVID, the effects of hot desking and being able to come away from a long 10 or 15-year lease and move into flexible office space. What was the trend was changing anyway prior to COVID. I believe that offices, the basis of getting up in the morning and going to an office won't change. I don't believe that will change. I believe that it will look slightly different. So if a law firm in the city, because of COVID, now believes that it doesn't need 600,000 square foot and it's going to scale down to 400,000, then that is, you know, one direct effect of COVID. But I don't believe that the office sector is going to change in how we work and how the journey, if you like, of someone's day, that they get up and go to an office.
Sure, we've just had a question which sort of follows on from that really, Haim. Will working from home mean that people will move out of central London, which will in turn impact house prices? What do you think about that?
We've already seen that. We've already seen it. We saw it last year, speaking to estate agents on the ground, dealing with homeowners. A lot of people were feeding into us saying that some people, they've, because of lockdowns and COVID, that they've changed their priorities in life and they prefer to move out into the country or commuting distance into central London. And I believe that that's choice. And if people do decide to move out, we're talking about a small percentage compared to the population of London. And there'll always be the reverse happening, where people are moving from outer cities or towns that want to come to the capital. So I believe that it's horses for courses, and there will be some change, yes.
Yeah, I'd agree with that. I mean, I think that what it's done is made people make a decision on something that they were sort of considering for a time, you know, moving out to the country or moving out to a commuter area, which was something they were probably going to do anyway. But I think the sort of death of London, you've seen some of these headlines around the place, and the sort of perception of tumbleweed going through down Oxford Street and all the rest of it. I mean, yes, London has had a hard time, no question. But there is more to London than, you know, people living there just because they work around the corner. I mean, there's everything else that London holds that retains its position as, you know, one of the top international investment destinations. You talk about investing in the UK, people straight away assume it's London. And that won't change, I don't think. In terms of, you know, that brings us on to currencies. And one of the questions we were asked about prior to this event was, you know, currencies and interest rates, because the two obviously are linked. I mean, today I noticed that the pound is 140 against the US dollar. It's probably just under 11. I haven't looked today against Hong Kong dollar, somewhere between 10.5 and 11. So it's as expensive as it's been, or as strong as it's been in the last sort of 3 years. But in relative terms, if you go beyond that 3 years, I mean, its traditional sort of trading range was somewhere between 145 and 150 for the US dollar, even slightly above. The more senior of us will remember when it was $2 to a pound, which doesn't seem that long ago, but it certainly was. And certainly, you know, from the Hong Kong dollar perspective, I remember it was, I mean, when I first got to Asia in 1997, it went up to around about 15, 16 to a pound, and then it typically settled down to around sort of 12.5. So the purchasing power of dollar against sterling is still very strong, albeit not as strong as it was, but it still offers value, I think, is the key. And you're not buying into an asset just because it's a currency play, but it all helps. I mean, you don't get taxed on any currency upside. And it looks as if, you know, the sterling rates are now sort of stabilizing. I mean, currencies do not like uncertainty, and at least now we have some certainty, certainly as far as Brexit is concerned, increasing certainty around COVID. So it looks to me that this sort of volatility of sterling, stroke US, stroke euro, stroke Hong Kong dollar is going to be less so. I mean, I'm not saying it's completely finished, but the whole sort of volatility and wild swings of 5-6% you see in a day seems to be over for the time being. Yet there's still opportunity there, I think, for foreign investors, and certainly the ones that, I mean, you were involved in quite a large transaction, weren't you, Chaim, towards the end of last year, and currency certainly came into it, didn't it?
Yeah. So we acquired a building in St. James's called Smithson Plaza, which used to be the home of the Economist newspaper. And we bought that for a very, very large Chinese insurance company for 158 million pounds. There was fierce competition from American funds, German funds, and that there was over 20 bids to buy this asset. Just goes to show, even with Brexit and COVID, the demand for UK and income producing assets.
Yeah, absolutely. I'm just looking at some more questions that we've had in. Talking about supply in the market, given that there's almost a weekly or also advertisements and exhibitions of London properties in Hong Kong, is there an oversupply of London property? And that's a good point, because, you know, what we read in the paper about undersupply and reaching only a third or 2/3 of the targeted house building in the UK, yet it seems that the South China Morning Post or Singapore Straits Times just seems to have sort of no end of property exhibitions. So it seems to be slightly counterintuitive. What do you think about that, Chaim?
So my view to that is selling off plan has been going on for many, many, many years. And a big driver for a developer to sell off plan is, one, funding. So he could go to the bank, they could go to the bank, and the funding would be a lot easier if they had some pre-sales. So that's one. And secondly, UK owner-occupiers don't typically buy off-plan. In some countries, that's very fashionable and it works well, but in the UK, that's never been an exercise that local buyers, that they wait till it's built. And the main reasons is look, touch and feel, as well as a mortgage. And the owner-occupier market is very strong, very, very strong. I remember reading in the press about sometime in the future, the UK becoming like Germany, where the majority of the population are renters and not homeowners. I've been in this industry for coming up to 26 years, and everyone that I speak to, even my peers, it's not something that we believe in. It's been embedded in us since a very, very young age to own our own property, own a roof over our heads. And no, I don't see that there's an
change
oversupply
anytime soon. I mean, what I would say is that there seems to be a lot for sale potentially at these exhibitions. My key point here would be just to understand the affordability, because in all of these areas, people will be earning an average sort of wage, whatever that average is, but just try and do some homework and understand what people earn in that area, and then reverse engineer it back. Can they then afford to pay a mortgage or rent in that area? Because you'll soon work out if you are buying something that's reasonable value that can appeal to the masses in the area that you're looking at or not. And if it is affordable, it will rent or it will sell. There's no problem with that, because as Chaim says, there is still that fundamental undersupply in areas. The problems come when you're buying property in an area that just doesn't fit the local dynamic. And we see that sometimes, you know, these sort of bright, shiny new builds by the size of the Thames, and you sort of look at the pricing there and you think, oh, you know, how's that going to work in terms of what people earn around there, and the rent that they can afford to pay. So it does mean that before you buy, and I'm sure, you know, most of the people listening here will do that, but you've got to do your homework and just understand the type of profile of person that's going to be live there. I mean, what's your sort of avatar of renter or secondary purchaser, and just make sure that they do exist in the area that you're buying in, and make sure that the affordability it fits in with what you're trying to achieve.
Yes, I agree.
Question that we always get asked: what should I buy? A studio, 1 or 2 bed unit? What do you think, Hein?
Again, preference, but if the question is it easier to rent or sell? I believe a 2-bedroom apartment would appeal to a wider spectrum of tenants and purchasers than a studio or a 1-bedroom. We can't discount affordability, but my answer is a 2-bedroom apartment would appeal to a wider audience.
Yeah, I agree. I mean, also from an affordability standpoint, again, I mean, you know, living in these bigger cities, be it Birmingham, Manchester, Liverpool, London, it's not a cheap business, and the ability to actually share and divide up bills, etc., is something to be considered. Plus, also the point about working at home. I mean, in the days that we live in now, and I think going forward, more people will be spending more time at home, probably working 1 or 2 days a week if they possibly can, and having that extra room as a sort of study stroke spare room adds that element of flexibility. So as Haim says, you know, it comes down to affordability, but when I get asked this question, I do say, well, look, if you can stretch that way, and the affordability is still there, then 2 beds would certainly be my preference. We're being asked about interest rates quite a lot. I mean, what are you hearing, Haim, in terms of sort of chatter and noise in the market about interest rates? And again, what are your institutional guys thinking that may or may not happen?
A lot of the clients that we deal with are hedging or saying that there'll be or could be negative interest rates, and that there would be an even larger investment case to investing yielding assets. If interest rates were to go up, we're at historic lows, and we have been for so many years. I personally believe that we're going to be in a very low interest rate environment for quite a few years to come, and if there are increases, that they'll be very small, and it will still be affordable to borrow money, but I can't see any very large interest rate hikes, if anything negative.
Yeah, I agree. I don't think we've got an option here. The world seems to be addicted to sort of lower interest rates and cheap borrowing, and it's the world economy is in quite a fragile state. So I think that for the time being, most countries, policymakers will adopt the sort of status quo and leave things as they are. I mean, I do notice that there's talk of interest rates, inflation now sort of back on the horizon. I noticed there was a big sell-off of tech stocks yesterday, or the day before actually, because of that concern that inflation is around the corner, and that is inevitable. But looking at property, you know, what better way to hedge against inflation than buying a sort of hard yielding asset? And I think you know, a lot of institutional buyers are looking that way. Conscious of time, so we've probably got time for another couple of questions. I think we'll keep going for another 5 minutes or so, and please do, if we finish this presentation earlier, and you do still have questions, please feel free to send them our way, and we'll do our best to address those. We've got a question here: would the second home buyer investor be deterred with additional 2% stamp duty. So I think what Joseph is referring to is that the foreign stamp duty that will come into place in April, I think this year, isn't it, Chaim? An extra 2% added on the price. Do we think that will deter investors, overseas investors?
No, I don't. I don't at all. In the commercial world, tax has changed for inward investors. So a few years ago, overseas investors could invest in commercial property by way of companies and then sell those companies and not have to pay any capital gains. That's all stopped, and that hasn't changed or affected at all. I believe that it will be a consideration for the investor, and it might have to be factored into the price, the additional 2%, but it won't deter that there'll still be demand from overseas investors for UK. Yeah,
I'd agree. I mean, I remember actually it was announced in the last budget last year. And I remember saying to you, Chaim, I mean, what do you think about that? And I think you were quite relieved because, I mean, there has been chatter about this foreigner stamp duty for a while. Quite a few of the governments had discussed it, but no one had implemented it. So there was concern that it was going to happen. But I think the general consensus in the market is that actually 2% could be an awful lot worse. I mean, if it was sort of 3, 4 or 5, then that would have a meaningful effect, or could have a meaningful effect on foreign investors. I mean, don't forget, you know, you're investing in Hong Kong, you're investing in Singapore. I'm not sure about Singapore, but you know, you're facing double stamp in places like Hong Kong if you're not a permanent resident there. So it could be a lot worse. And I think there are very few cities that or countries that don't differentiate to some extent between foreign and local buyers. So 2% in the grand scheme of things shouldn't really make too much difference. Last question. So put you on the spot, Chaim. This year, what do you think is going to happen with London properties if we talk about residential, if we talk about in the price point of say £400,000 to £750,000 range? What do you think is going to happen in that end of the market?
Well, I believe pricing is very much going to hold, and if not increase. Again, it goes back to the fundamentals of supply and demand. We just simply don't have enough housing for the requirement, and 400,000 to 700,000. Yes, it is out the reach of a lot of people that are on low income, but I do believe that the pricing's going to hold in that bracket. And
where do you think it might not hold? Where do you think it may come off in London? What end of the market?
Some locations where the value was always off plan, so on paper. And if we take St John's Wood as a location, I remember, I don't know, 4, 5, 6 years ago that there were sales that were happening off plan, £2,000 per square foot, and those values had never been achieved for built stock in this location. So I believe some areas of London were overinflated, and that there could be a correction of maybe 10% in value. But in most locations that are affordable, the fundamentals are still there, that there's plenty of demand and not enough supply.
Yeah, I think going back to what you said earlier on, it's about common sense. It's about staying close to transport hubs and those regeneration areas, which may be a bit counterintuitive. I mean, I was talking about the emotional side of property investment last week or 2 weeks ago, where people tend to get a little bit more emotionally involved than they should, and buying in an area that they don't particularly like the look of. But consequently, those are the areas that will perform the best in the next sort of 5-10 years, as they are gentrified and things do change. So for us, that's what we'll stick to in terms of our strategy. Yeah, I think on the letting side as well. I mean, we manage around 2,000 properties up and down the UK, and yeah, the rental market has never been stronger. And I think one of the reasons for that is because people have been adopting this sort of wait and see, and should I buy, should I not? Let me wait for things to calm down a bit, sort of post-pandemic, post-Brexit. So I think, yeah, there is that stability in the market now, which will hopefully lead to from strength to strength. So on that note, thank you, Chaim. Thank you very much for joining us this morning. Thank you everyone for listening. Again, if you do have any other additional questions, please send them our way, and we will do our best. And I again look forward to meeting you on the next webinar. So thank you very much indeed.
See you. Thank you. Bye bye.
Thank you.